Okay, it's the holiday season, but the economic battle isn't stopping. As we all prepare for the new year, the West is also reviewing its plans for 2025. Trump is prepared for a trade war with China. The EU as a whole continues to reject collaboration with Beijing. However, the United Kingdom, like Italy and Spain, is beginning to see the reality. There is no way to survive this instability without the Chinese economy. And it's a significant shift. We recall Starmer questioning President Xi on human rights at the G20 summit. But there is now a significant shift to Beijing. It's a complete 180 out of nowhere. The United Kingdom will travel to China in January. Rachel Reeves, the Chancellor of the Exchequer, is trying to strengthen business links. Trump has won, and his global trade agenda is set to begin. His global trade war is approaching. Europe is being threatened with purchasing further U.S. oil and gas. And Starmer is concerned that the U.K. will be next on the list. Tariffs, as you would expect, are not my favorite topic. As a result, we must exercise caution in order to avoid tariffs. And if you're Starmer, there are just a few options for tariff-proofing your economy. Well, Europe is your largest trading partner. In a peaceful society, it makes perfect sense to strengthen collaboration. And on paper, this appears to be the winning strategy. 42% of UK exports go to the EU. Furthermore, Europe accounts for more than 50% of all UK imports. So the reliance is massive. It cannot be overstated, but let us predict Europe's fate over the next 4 years. What would happen if the EU was compelled to buy pricey energy from the United States? The cost of production would rise. The UK will buy more costly goods and try to sell them to a poorer economic bloc. To lift the UK out of its slump as a technology nation, they must alter their trade policy. Brexit has had a negative impact on the British economy, particularly on its exports. It's critical that we measure the damage done to British firms. Brexit caused a £27 billion harm to the UK's exports in 2022. Small businesses failed, and over 16,000 organizations stopped exporting to the EU. This chart now displays a worrisome trend. Smaller businesses in the UK suffered an astonishing reduction in exports by up to 40%. Now, larger organizations may be doing better, but the general trend remains downward. And with Trump's trade war looming, the UK can no longer rely only on Europe. Trump wants NATO as a whole to contribute 5% of GDP to defense, and the money must come from someplace. Money spent on defense is most likely used to purchase U.S. weaponry and equipment. Let's be realistic about it. That is not good for the EU or the UK economy. Europe will be too broke to expand trade. As a result, the United Kingdom, like many other EU countries, is forced to turn to China, the only economy that is both growing and detaching from the United States. Watch what they do, not what they say. It pays to examine the United Kingdom's commercial connections. Now, of course, the United States is their single largest trading partner, over $100 billion in imports and exports. However, China is the UK's backup plan in the case of a trade war. Chinese imports are a close second, at £56 billion, and we know China transmits deflation. Therefore, the UK needs those low-cost commodities, especially if they want to counter-tariff the US. Overall, exports rank second. Now, the UK has only exported $21 billion to the Chinese mainland. But don't forget about Hong Kong's £10 billion. Hong Kong remains part of China. China as a whole is the second largest importer of UK products, so you can see Britain's reliance on the Chinese customer as well. This is the benefit of China's decoupling. They are breaking away from the US and developing their own consumer market. And this makes it highly appealing for countries looking to hedge against the United States in 2025. If the Americans hit us on trade, we can counterattack. And we will just purchase and sell more in the Chinese economy. And this isn't a unique incident. It is going to become the dominant trend. It is surprising that the United Kingdom is conducting a stealthy turn. We should trade and seek investment when it is in our national interests. Suddenly, the narrative of China helping Russia seemed to have evaporated. However, the fall of the UK auto sector might also be to blame. Maybe, just maybe, they seek assistance from Chinese EV manufacturers. The British automobile industry is collapsing. There are even proposals to shut the Vauxhall factory in Luton. An ancient Stellantis factory may be closing, similar to the situation in Germany. Production costs in the UK, as in Europe, are simply too high. The technology, particularly electric vehicles, is several years behind China. UK output has fallen by 30% from a year earlier, and this concludes 9 months of uninterrupted deterioration. From 1.8 million autos in 2017 to less than 900,000 in just 7 years. So someone needs to fill in the blanks. If Trump wants to bring manufacturing back to the United States and compel Europe to buy costly energy, it might create an industrial catastrophe. Having Chinese corporations come in might be the only backup plan available. So 2025 will be a very turbulent year for the United Kingdom. But let's shift gears and discuss the Biden administration's final shot. Once again, it is a desperate attempt to stifle China's semiconductor sector. However, it indicates that the chip battles are not done yet, and it will continue under Trump's administration. The United States is now targeting China's legacy semiconductors. Their frequent argument is over capacity. Beijing is once again attempting to dominate the global semiconductor business. Now, chips are required for automobiles, computers, televisions, weapons, and even washing machines. There are older versions that are many generations removed from AI chips. The United States has already prohibited Chinese imports of sophisticated semiconductors and chip producers. Companies like ASML and Tokyo Electron are unable to sell their top gear to China. But attacking older chips would put Beijing on high alert. It will cause all prices to skyrocket. China currently accounts for more than 30% of mature chip production, and by 2027, it will account for 39% of worldwide production. So whether you buy an electric vehicle, a television, or a laptop, the chips inside are likely created in China. And when China seizes an industry, they go all out. Like solar panels, China reduces manufacturing costs, and they increase manufacturing to get greater market share. By 2030, China is expected to have enough factories to produce 50 million 12-inch wafers a year. That's more than the United States, the European Union, and Taiwan combined. As a result, our capacity to compete in the West is rapidly dwindling, and this is why Biden is currently attempting to penalize legacy chips. When you can't compete, trade barriers begin to rise. You isolate your economy from Chinese imports in the hopes of increasing your own capability. Now, according to Raimondo, semiconductor firms are afraid to invest in the United States. Why? Because Chinese vendors offer their chips for 30% to 50% less than U.S. sources. And this is Beijing's supply chain advantage. They have cheaper energy and control over mineral inputs. Producing in China and delivering all the way to the United States is still cheaper. So we can view the playbook. Terrorists equipped with Chinese legacy chips are on their way. Maybe it is 50%. Maybe it's 100%. Maybe it's 200%. It's the only alternative the U.S. has if Trump wants to reshoe manufacturing at home. However, this will result in a market divide between nations that have access to low-cost semiconductors and others that impose tariffs on Chinese imports. By 2030, electronics would account for half of a car's overall cost. Furthermore, EVs have at least 3,000 semiconductors, including mass-produced chips. Americans will pay more for autos. The chips will undoubtedly be created in the United States, but domestic pricing will almost certainly be higher, while other countries, including those in Asia, will pay less. And this, ladies and gentlemen, will be the direct cause of a tariff war. Two different markets, one for countries that continue to trade with China and one for the U.S. market, which is becoming more isolationist. A shift in global commerce is only the beginning. When China deals less with the United States, something clear will happen. Chinese merchants will deal less in dollars, reducing China's need to keep dollar reserves, which should serve as a major wake-up call. China's holdings of U.S. bonds have once again fallen to a new low. They currently own only $760 billion in U.S. debt, a $37 billion drop despite rising bond prices. So China is either letting its assets mature and roll off or actively selling. This figure is likely to fall much lower in the future. This poses a significant challenge to the U.S. economy in the future. Reshoring is a very costly undertaking. Let us recollect what happened just a week ago. While the Federal Reserve reduced interest rates, Power has indicated that there would be fewer cuts in 2025. So we could only receive 1 or 2 cuts next year. The Trump administration will issue bonds while borrowing prices remain extremely high. Yes, there will always be demand in the Western world. G7 nations will remain net purchasers. However, if China boosts bilateral trade with the BRICS, global demand will fall more. Something strange is going on with the Treasury yield curve. The blue curve depicts yields in September. The 2-year yield was 3.6%. The 10-year yield was likewise at 3.6%, but yields have begun to rise along the longer end of the curve. The 10-year bond currently yields more than 4.5%. The 10-year is the baseline for all other borrowing rates in the United States. As a result, corporations are still subjected to rising interest rates. Foreign purchasers for U.S. Treasuries are significant. It'll be intriguing to observe how Trump will boost demand. Threatening tariffs will not work since it limits commerce and hence the flow of funds. Beijing has also begun to issue its own dollar-denominated bonds. Their demand is virtually comparable to that of the United States, and this will complicate Washington's financial strategy. If the Chinese continue to borrow dollars from throughout the world, yields will rise immediately across the board. Buyers will seek a greater return, and things continue to become stranger. Chinese investors are increasingly buying dollar bonds issued by the Chinese government. Let me repeat, Beijing is selling dollar bonds to its own citizens in order to prevent money from migrating to the United States. They want to retain the cash in-house. Because of this extraordinary demand, the rates on China's dollar bonds fell below those issued by the Treasury. In other words, China could borrow U.S. dollars at a lower cost than the U.S. government. And that's how weird things have gotten. There are huge transformations taking place. 2025 is going to be more crazy. Western countries are peeling away one by one. U.S. sanctions are also becoming increasingly desperate. China is also exploring new methods to disrupt the currency system. Things will never be the same again. Stay safe. Be sure to like and subscribe as we navigate these tumultuous times.